The United States owes $36 trillion. Not million, not billion, trillion. It is the largest pile of government debt ever accumulated in human history. Larger than the entire U.S. economy. Larger than the global economy was just a few decades ago. And every single year that number keeps growing. Now here's the part most people never stop to ask. How exactly is this debt supposed to be repaid? Because if you listen to politicians, the answer is always the same. They tell you it will be handled responsibly. Through future growth. Through smart policy. Through innovation, productivity, and long-term stability. But if you look at the math, not the speeches, not the headlines, just the math, something doesn't add up. At current levels, the government spends over $1 trillion every year just on interest. Not reducing the debt. Not paying it down. Just interest. Before a single dollar goes to roads, schools, defense, or healthcare. And those interest costs are rising fast. So let me ask you something important. Do you really believe this debt will be repaid the traditional way? Through higher taxes? Through massive spending cuts? Through explosive economic growth that somehow outpaces decades of borrowing? Because there is a far more realistic answer. An answer that is legal. An answer that has been used before. An answer so subtle that most people won't realize it's happening until the damage is already done. The truth is, the government is not planning to pay this debt back in real terms at all. They are planning to erase it quietly. Not by defaulting. Not by missing payments. Not by triggering a crisis. But by changing what those payments are actually worth. Right now, while you're watching this, a process is already underway. A process that slowly reduces the real value of government debt, not by touching the number on paper but by weakening the currency used to repay it. And the cost of this strategy doesn't fall on politicians or institutions. It falls on savers. On retirees. On bondholders. On anyone who believed that government debt was safe. This isn't speculation. This isn't a conspiracy theory. This is a documented monetary mechanism with historical precedent. One that has transferred trillions in wealth before. In this video, we're going to break down exactly how this works. Why inflation is not a mistake but a tool. Why fixed-rate debt changes everything. And why the largest wealth transfer of the modern era is happening in plain sight. This is not about politics. This is about incentives. And once you understand those incentives, you'll never look at inflation the same way again. Welcome to Finance Archives. Let's assume, just for a moment, that the government actually wanted to repay this debt the traditional way. No tricks. No monetary games. Just honest repayment. What would that look like? The first option is taxes. To meaningfully reduce a debt this large, taxes would need to rise dramatically, not just on the wealthy, not just on corporations, but on everyone. Income taxes, consumption taxes, capital gains. All of it. And even then it wouldn't be enough. Because when debt reaches this scale, taxation stops being a solution and starts becoming a drag. Higher taxes slow economic activity, reduce investment, and shrink the very tax base they're supposed to grow. You don't tax your way out of a debt that's larger than your annual economic output. The second option is spending cuts. But take a look at where the money actually goes. Social Security, Medicare, defense, interest on the debt itself. These are not line items you can casually slash without triggering political backlash or economic instability. Cutting deep enough to matter would mean benefit reductions, mass layoffs, and a collapse in public support. No administration survives that. Which leaves the third option, economic growth. This is the most comforting story. The idea that innovation and productivity will lift all boats and slowly make the debt manageable. But here's the problem. The debt is growing faster than the economy. Every year, new borrowing is added just to maintain existing obligations. Growth would need to be not just strong but historically unprecedented, sustained for decades, simply to keep the debt from getting worse. And even if that miracle happened, the interest clock doesn't stop ticking. So when you strip away the talking points, what you're left with is a hard reality. There is no realistic path where this debt is paid down in real terms through taxes, cuts, or growth alone. Which means something else has to give. And that something is the value of the currency itself. Because when debt is denominated in your own currency, and most US debt is, you don't need to default to reduce the burden. You just need the money to be worth less. This is where inflation enters the story. Not as an accident. Not as a temporary side effect. But as the only mechanism large enough, quiet enough, and politically survivable enough to deal with a debt of this magnitude. And the most important detail, the detail that makes the strategy so effective, is how the debt is structured. Most of it is fixed rate. That means the interest payments are locked in. The amounts are set. The government knows exactly what it owes in nominal dollars, years into the future. So if inflation rises above what lenders expected when they bought those bonds, something remarkable happens. The government pays back every dollar it promised. But those dollars buy less. Much less. And that difference, that silent erosion of purchasing power, is where the real repayment happens. In the next section we're going to walk through that mechanism step by step. Not in theory. Not in abstraction. But in simple math. Because once you see the numbers, it becomes impossible to unsee what's really going on. Let's strip this down to something simple. Imagine you lend someone $100. They promise to pay you back $100 in 10 years. On paper that sounds fair. But 10 years later, those same $100 only buy what $50 used to buy when you made the loan. Did they repay you? Legally, yes. In real terms, absolutely not. Half of your purchasing power is gone. This is the core mechanic behind what's happening right now. When governments issue debt at fixed interest rates, they are locking in future payments in nominal terms, not real ones. The numbers don't adjust for inflation unless the bond is specifically indexed, and the vast majority of U.S. debt is not. So when inflation rises above expectations, the borrower wins. And in this case, the borrower is the government. Every percentage point of inflation above what bondholders expected represents a transfer of wealth. Not through legislation. Not through taxes. But through arithmetic. Here's how it works in practice. If you bought a 10-year government bond when inflation was expected to run at around 2%, and inflation instead averages 4%, you're losing 2% of purchasing power every year. Over 10 years that compounds into a massive real loss. You still receive your interest payments. You still get your principal back. But what those dollars can actually buy has been quietly hollowed out. Now scale that up. Not to one bond. Not to one investor. But to $36 trillion in outstanding government debt. Suddenly, what looks like modest inflation becomes one of the largest wealth transfer mechanisms ever created. And here's the crucial point. This doesn't require runaway inflation. It doesn't require hyperinflation. It doesn't require a currency collapse. All it requires is inflation that is slightly higher for slightly longer than people expected. That's it. One extra percentage point sustained over a decade reduces the real value of existing debt by trillions. 2 points does even more. And none of it shows up as a missed payment or a default. From the government's perspective, it's elegant. The debt doesn't disappear on paper, but it shrinks in real terms. Quietly, gradually, legally. And from the public's perspective, it's almost invisible. People don't see a line item called inflation tax on their paycheck. They don't get a statement saying, your savings lost 12% of its real value this year. They just notice that groceries cost more. Rent keeps rising. Savings don't stretch as far as they used to. And most never connect those changes to debt policy. But this isn't a new idea. This exact strategy has been used before, deliberately, successfully, and at enormous cost to savers. To understand why policymakers are so comfortable with this approach, we need to go back to the last time the United States faced a debt problem this large. Because history didn't just rhyme. It provided the blueprint. In the next section we'll look at how inflation was used after World War II to erase government debt, and why today's situation may be even more favorable for repeating that playbook. Here's the part of the story that almost never makes the headlines. Inflation doesn't hurt everyone equally. In fact, it's not random at all. It creates very clear winners and losers, even if most people never realize which side they're on. When inflation runs higher than expected, the biggest losers are not governments or large institutions. They are ordinary people who did exactly what they were told was responsible. People who saved. People who avoided excessive risk. People who trusted government-backed assets. Savers watch their cash lose value year after year. Retirees living on fixed income feel their purchasing power slowly shrink. Bondholders receive payments that look stable on paper, but buy less with every passing month. And the cruel irony is this. The more conservative you were, the more you're punished. Government bonds are marketed as risk-free. Savings accounts are framed as safe and prudent. Pensions are built around stability and predictability. But inflation quietly turns all of that against you. Because while prices rise, the returns on these assets often don't keep up. Especially when interest rates are held below inflation. That gap, the space between what you earn and how fast prices rise, is where the wealth transfer happens. And on the other side of that transfer sits the government. Inflation reduces the real value of its obligations. It lowers the true cost of interest payments. It makes yesterday's borrowing cheaper to repay tomorrow. No vote required. No legislation passed. No public debate. And that's what makes this mechanism so politically powerful. Raising taxes creates backlash. Cutting benefits creates outrage. Inflation creates confusion. People don't protest inflation the way they protest tax hikes. They argue about prices, not policy. They blame companies, landlords, or global events. Meanwhile, the real beneficiary remains largely invisible. This process even has a name in economics. It's called financial repression. It describes a system where interest rates are held artificially low, often below inflation, while savers are left with no safe alternatives that preserve purchasing power. You earn nominal returns, but lose in real terms. And it doesn't stop there. Inflation interacts with the tax system in a particularly destructive way. Most taxes are applied to nominal gains, not real ones. So if you earn 5% on an investment while inflation runs at 4%, your real return is just 1%. But you're taxed on the full 5%, which means after taxes your real return can drop to 0, or even turn negative. You're effectively paying taxes on inflation itself. The government debases the currency, then taxes the illusion of profit created by that debasement. Again, legally, systematically, quietly. And once you understand this, an uncomfortable question emerges. If inflation harms savers, retirees, and cautious investors, and benefits the government, why would policymakers ever be truly aggressive about stopping it? To answer that, we need to look backward. Because this isn't the first time a massive debt problem was solved this way. The blueprint already exists. And it worked. In the next section, we'll go back to the aftermath of World War II, to the moment when inflation and suppressed interest rates erased one of the largest debt burdens in American history. To understand why this strategy feels so familiar to policymakers, we need to go back to a moment most people view as an economic miracle. The years after World War II. In 1946, the United States was drowning in debt. Federal debt had exploded to more than 100% of GDP, higher than it had ever been before. Economists at the time warned that the country faced decades of stagnation, crushing interest costs, and fiscal collapse. Sound familiar? But that collapse never came. Instead, something remarkable happened. Over the next few decades, the debt burden seemed to fade away. By the early 1970s, federal debt had fallen to a fraction of the economy. And it didn't happen because the government ran massive surpluses. It didn't happen because taxes skyrocketed. It didn't happen because spending was slashed. It happened because the debt was quietly inflated away. From the late 1940s through the early 1950s, inflation ran persistently above interest rates. Prices rose. Wages eventually followed. But government bond yields were kept artificially low. For years, investors earned returns that failed to keep up with inflation. In real terms, they were losing money. And this wasn't an accident. The central bank worked in coordination with the Treasury to cap long-term interest rates, even as inflation climbed. Bondholders had no escape. If you held government debt, you accepted negative real returns, or you absorbed losses by selling. This period became the textbook example of financial repression. The government met every obligation. Every bond was honored. Every payment was made on time. But the dollars used to make those payments were worth less every year. And the result? A massive reduction in the real debt burden without a formal default. No crisis. No panic. No public reckoning. Just a slow, steady erosion of purchasing power borne by savers and creditors. And here's the part that rarely gets emphasized. This strategy worked because most of the debt was fixed rate and denominated in the government's own currency. Inflation did the heavy lifting. By the time investors realized what was happening, the process was already complete. Now fast forward to today. The structure looks eerily similar. High debt. Fixed rate obligations. A central bank with enormous influence over interest rates. And a political environment where traditional solutions are off the table. Which raises an unsettling possibility. What if the post-war playbook isn't history? What if it's policy? Because in many ways the current setup is even more favorable for repeating this strategy, and potentially on a much larger scale. In the next section, we'll look at why today's version of debt inflation may be more powerful than anything seen in the 20th century. There's one crucial difference between the post-war period and today. A difference that makes this strategy even more effective, and far more powerful. Back then, most U.S. government debt was held domestically. Today, a massive portion of it is held abroad. Foreign governments, central banks, and institutions collectively hold trillions of dollars in U.S. Treasury securities. China, Japan, Europe, oil-exporting nations, sovereign wealth funds. This changes the incentive structure entirely. Because when inflation erodes the value of U.S. debt today, a significant share of the cost is exported overseas. Foreign creditors receive their payments on time, but in dollars that buy less. Their real returns shrink. Their purchasing power erodes. From Washington's perspective, this is extraordinarily convenient. Reducing domestic debt burdens is politically difficult. Reducing foreign-held debt through inflation is politically invisible. And what can these creditors do? In theory, they could sell their treasury holdings. In practice, that's nearly impossible. Dumping large quantities of U.S. debt would crash bond prices, hurting the value of what they still hold. It would also destabilize global markets and damage their own financial systems. So they're trapped. They can't sell without harming themselves. They can't hold without accepting losses. And they can't easily find an alternative asset with the same liquidity, scale, and global acceptance. This is the reserve currency advantage in action. U.S. Treasuries aren't just investments. They are collateral. They are reserves. They are the backbone of global finance. Which means demand remains strong even when real returns are negative. And it doesn't stop at foreign creditors. The same dynamic applies globally. Central banks across the developed world are pursuing remarkably similar policies. Low interest rates, high debt, tolerance for inflation above historical norms. This isn't coincidence. It's coordination. When all major currencies are being debased at the same time, there is nowhere for capital to hide. Moving from dollars to euros doesn't solve the problem. Neither does moving into yen or pounds. Every major sovereign bond market offers negative real returns. This creates a kind of global prisoner's dilemma. Investors know they're losing purchasing power. But they also know that alternatives are limited. So they stay. And by staying, they allow the process to continue. Meanwhile, the U.S. enjoys another advantage. Because so much global trade, energy, commodities, international settlements, is denominated in dollars, inflation created in the U.S. doesn't stay in the U.S. It spreads. Other countries import inflation without importing the benefit of debt reduction. Their currencies weaken. Their costs rise. But their obligations remain. In effect, the U.S. exports part of its inflationary burden while keeping the debt relief for itself. And that makes this moment historically unique. Never before has a single country been able to inflate away debt while simultaneously distributing the cost across the global financial system. Which brings us to the final question. If this strategy is legal, if it has historical precedent, if it shifts the burden away from voters and onto savers and foreign creditors, why would policymakers ever stop? In the final section, we'll tie everything together and explain why this may be the most politically sustainable form of wealth transfer ever created. And why most people won't recognize it until it's already too late. By now, the pattern should be clear. This isn't chaos. This isn't incompetence. And it isn't a temporary mistake that will soon be corrected. It's an endgame. A system designed to look stable on the surface while quietly shifting the burden underneath. The government doesn't need to announce debt forgiveness. It doesn't need to default. It doesn't need to raise taxes or slash benefits overnight. All it needs is time. Time for inflation to do what legislation cannot. Time for fixed-rate debt to shrink in real terms. Time for purchasing power to erode slowly enough that no single moment triggers outrage. Every year that prices rise faster than interest rates, the debt becomes easier to carry. Every year that savers earn nominal returns below inflation, wealth moves silently upward. Every year that people argue about prices instead of policy, the mechanism remains protected. This is why inflation is tolerated longer than expected. Why forecasts keep missing to the upside. Why temporary price pressures linger. Not because inflation is harmless, but because, at this scale of debt, inflation is useful. It allows promises to be kept in name while broken in substance. It turns yesterday's borrowing into tomorrow's discount. It transforms obligation into illusion. And the most effective part of all of this? No one needs to vote for it. There is no bill titled Wealth Transfer Act. No headline announcing trillions erased through currency debasement. No official acknowledgement of who pays the price. People just feel poorer. Savings don't stretch as far. Retirement feels more fragile. The future feels tighter even when numbers look fine on paper. And most never connect those experiences to the underlying system. History shows us this approach works. The present shows us it's already underway. The only unknown is how long it will continue, and who will understand it in time. Because once you see this mechanism clearly, you start asking different questions. You stop judging policy by words and start judging it by incentives. You stop focusing on short-term noise and start watching long-term erosion. And that awareness matters. If you want to understand how financial systems really work, not how they're marketed, not how they're explained in sound bites, this is exactly what Finance Archives exists for. If this breakdown helped you see the bigger picture, consider subscribing. These archives are built for people who want context, history, and clarity, not headlines. Because the most important financial events rarely announce themselves. They unfold quietly over time. And by the time everyone notices, the outcome is already locked in.